Hey guys, Benjamin Smith with Caliber Home Loans. My NMLS number is 372396. You can look me up on nmlsconsumeraccess.org. We're continuing on about mortgage insurance. Today I wanted to put this one on a focus on conventional loans. So conventional loans are underwritten to Fannie Mae, Freddie Mac guidelines, basically. And we call mortgage insurance on those products PMI, which I've always taken as private mortgage insurance because it's coming from an outside company, basically. So there is a choice of private mortgage insurance companies, MGIC, Radian, many others. We tend to kind of treat them all the same and just pick whoever's offering the best situation for our clients and all of that. So as we discussed, mortgage insurance covers the lender, but you have to pay it. So on conventional loans, what you pay completely depends on how much you put down. So in a circumstance where you put 20% down on the loan, there is no mortgage insurance. You have established enough equity in the home. There's very little risk to the lender that they're going to take a loss in the event you don't make your payments. You've already established equity in there so that if they have to sell it, they're fine. So that's why you don't have any if you're at 20%. If you go less than 20%, even half a percent less, there is mortgage insurance, and it's tiered depending on how much you put down. So between 80 to 85% loan to value, it's going to be its cheapest. If you go over that, if it's between 85 and 90, then a little bit more expensive. If you go 90 to 95, a little bit more. And the most expensive mortgage insurance is the 3% down option because there's so little out of pocket and so much more risk. However, Fannie Mae has a product called Home Ready, and Freddie has one called Home Possible. They're basically for first-time home buyers typically, and the eligibility for those is going to depend on where the property is that you want to buy, because there's sometimes income limits. Some areas have no income limits, just depending. So leave it up to us, your loan officers, to kind of check that out and find out any properties you might be thinking about that are eligible. Nice thing about those programs, bottom line, is it's a 3% down with a mortgage insurance payment that is reduced. And if the credit's pretty good, it is so much reduced that it can sometimes be less than 2% of the purchase price if you wanted to do a one-time payment. So we do have an option with private mortgage insurance to do a one-time upfront payment. That can be paid either by you out of your funds, or it can be paid out of the lender. If it's the lender, you have to take a higher interest rate because I got to come up with that money somewhere to pay it. I recommend that if you have the cash, do it yourself. So the game plan there, if that's what you're going to do, you're planning on 3% down. Typically, if the credit's good, you're going to be under 2%. Your mileage may vary just depending on your scores. So sometimes it can be a little bit more if you do a one-time. Sometimes a one-time doesn't make most sense. But the one-time payment almost always is less expensive than it is starting off with 3% down, making all of your regular payments with no extra dollars being thrown at the loan, and getting it paid off and down to that 20% range, which will lead into our next video briefly, where I will talk about how to get rid of private mortgage insurance if you don't do it up front with a huge down payment. Basically, you got to pay it down. So we'll get there, explain some of those details. So that's the story about conventional loans, private mortgage insurance. In recap, a little bit more expensive than depending on how much you put down. So if you put very little down, it's a little bit more per month. But most of the time, it's not more expensive than FHAs on a monthly basis. And it goes away, and there's opportunities for a reduced option. So you can be as little as under 5% out of pocket up front, 3% to down payment, under 2% for a one-time payment, and ends up being many thousands of dollars, typically less than it would be if you just made the monthly mortgage insurance payment. So we'll talk about how to get rid of that in the next feature, and we'll go from there. Thanks guys for listening. I appreciate it.